The Intelligent Investor is a timeless investment classic written by Benjamin Graham, known as the father of value investing. The book, originally published in 1949, offers a comprehensive guide to successful investing, emphasizing principles of value, discipline, and long-term thinking. Here's a detailed summary of the key points from the book. Introduction. What this book expects to accomplish. Benjamin Graham opens the book by distinguishing between two types of investors, defensive and enterprising. He emphasizes the importance of defensive investing, which involves minimizing risks and focusing on the long-term growth of investments. Chapter 1. Investment versus speculation. Graham differentiates between investing and speculating. He defines an investment as an operation that, upon thorough analysis, promises safety of principal and an adequate return. Speculation, on the other hand, is based on hope or belief rather than a careful analysis of intrinsic value. Chapter 2. The Investor and Inflation. Graham addresses the impact of inflation on investments. He explains that while inflation erodes the real value of money, intelligent investors should seek out investments that provide a sufficient margin of safety and protection against the loss of purchasing power. Chapter 3. A Century of Stock Market History. Graham provides a historical overview of the stock market, emphasizing that it has gone through significant cycles, including bull and bear markets. He underscores the importance of understanding market history and not assuming that trends will continue indefinitely. Chapter 4. General Portfolio. Policy: the defensive investor. The author outlines a conservative investment policy for the defensive investor, focusing on diversified investments in quality stocks and bonds. Graham introduces the concept of a fixed income portfolio and advises on asset allocation. Chapter 5. The Defensive Investor and Common Stocks. Graham discusses the selection of common stocks for the defensive investor's portfolio. He suggests a diversified approach and provided criteria for choosing individual stocks. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach D. This chapter is aimed at more aggressive investors. Graham discusses a policy based on avoiding stocks with unfavorable attributes, such as excessive debt, erratic earnings, and speculative hype. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. For enterprising investors, Graham provides a positive approach involving a more active selection of stocks. He suggests analyzing companies in depth and emphasizes the importance of buying stocks when they are undervalued. Chapter 8. The Investor and Market Fluctuations. Graham addresses market fluctuations and recommends a disciplined, non-emotional approach to investing. He encourages investors to ignore short-term market trends and focus on the long-term intrinsic value of investments. Chapter 9. Investing in Investment Funds. The author discusses the pros and cons of investing in investment funds, such as mutual funds. He advises investors to carefully analyze the expenses and objectives of these funds. Chapter 10. The Investor and His Advisors. Graham talks about the roles of investment advisors and provides guidance on selecting a competent advisor. He emphasizes the importance of understanding the investment process and not blindly following advice. Chapter 11. Security Analysis for the Lay Investor. General Approach. Graham provides an overview of security analysis for the individual investor. He explains the importance of analyzing a company's financial statements, understanding its business, and determining its intrinsic value. Chapter 12. Things to consider about per-share earnings. Graham discusses the significance of earnings per share, EPS, and highlights its limitations as a measure of a company's true profitability. Chapter 13. A comparison of 4. Listed companies. Graham compares 4 real companies to illustrate the principles of stock selection and analysis. This practical example provides insights into the application of his methods. Chapter 14. Stock selection for the defensive investor. The author summarizes his guidelines for stock selection for the defensive investor, including criteria such as a history of continuous dividend payments and financial strength. Chapter 15. Stock selection for the enterprising investor. For enterprising investors, Graham provides a checklist of quantitative and qualitative factors to consider when selecting stocks. Chapter 16. Convertible issues and warrants. The book explores convertible bonds and warrants as investment options, discussing their advantages and disadvantages. Chapter 17. 4 extremely instructive case histories. Graham presents 4 case studies of investment decisions, emphasizing the importance of thorough analysis and the potential consequences of speculative behavior. Chapter 18. A 5th case. History of investment. Graham provides another case study of an investment decision, illustrating the principles of value investing. Chapter 19. Margin of safety as the central concept of investment. The book concludes by highlighting the concept of margin of safety as the core principle of intelligent investing. Graham stresses that this principle helps protect investors from unexpected losses and should be a fundamental consideration in all investment decisions. The Intelligent Investor is a comprehensive guide to value investing that continues to be highly regarded by investors and financial experts. It emphasizes the importance of discipline, analysis, and long-term thinking in achieving financial success while minimizing risk. Benjamin Graham's principles continue to influence many successful investors and remain relevant in today's financial markets.